Good morning, students. This is Suresh, your commerce teacher from Government Degree College, Kukatpalli. Today, we will learn about Indian capital markets. You all heard about Bombay Stock Exchange, National Stock Exchange, buying shares, selling shares. Someone lost money in shares. Someone became multi-millionaire by buying shares of so and so company. So what this is all? It's all about capital markets. Friends, indeed, capital market is an important variant of financial markets, right? Financial markets of any country are bifurcated into money markets and capital markets. Money market is a short term funds market. You can get funds which are repayable within 1 day to 1 year or up to 5 years. They are called money markets. Whereas capital market is a source of availing long term funds. Some funds you have to repay after 10 years, some after 5 years, and some type of funds like equity shares you need not to repay at all. So they are called capital markets. I repeat, money market is a source of short term funds, and capital market is a source of long term funds for the corporate entities. And both together, that is, money market and capital market together, are called financial markets. Today, we will have a glance on Indian capital markets, which is one of the ancient capital markets of South Asia. So let's get started. I told you that capital markets are the avenues of obtaining long term funds by the corporate entities. That means companies limited and registered in stock markets. Indian capital markets represents one of the oldest market integrations in Asia, right? So China had its stock exchange only in 1980s, whereas India had its stock exchange way back in 1860. Therefore, Indian capital market is one of the oldest market integrations in entire South Asia. Capital markets are bifurcated into gilt edge and corporate securities markets. I repeat, capital markets will have two important variants. One is gilt edge market segment, and another one is corporate securities segment. So, what is this gilt edge market? It is an arrangement for trading government securities, right? That means a government organization or government department may issue some bonds, such other securities, which are completely secured. That means the risk of losing money is almost zero. They are called risk free markets or gilt edge markets. I repeat, in gilt edge market, government backed securities will be issued and traded. Therefore, the question of losing money, the risk of losing money does not arise in gilt edge market. It is also called GSEC market. GSEC market means government securities market. On the other hand, corporate securities segment, that means non government entities will issue their shares and debentures in a market segment called capital corporate securities segment, right? So in corporate securities segment or corporate securities market, risk factor will be there. Rather, risk of losing money will be very high because shares issued by non government companies are very vulnerable and the repayment of dividends or repayment of principal amount is not guaranteed by any government agencies. Therefore, they are risky markets, corporate securities markets, right? No matter whether it is a GSEC market or corporate securities market, you can conglomerate them and again redivide into primary markets and secondary markets. I repeat, in both gilt edge market as well as in corporate securities market, we will have again two segments. One is primary market, another one is secondary market. What is primary market? Primary market is also called as IPO, initial public offer segment, right? Here, companies or government directly issues their shares and other securities to the investors, right? For example, Reliance company is first time coming into market and selling its shares. I will directly apply to buy shares in Reliance company. That is called initial public offer or primary market. Clear? Primary market is a situation where corporate entities will issue their shares directly to the investors. Clear? It's between company and direct investor. On the other hand, we have secondary markets. Secondary market is a situation where already issued shares are traded between the investors. Let us suppose I have purchased shares from Reliance company in IPO, that is in primary market. I held those shares for 1 year in my demat account. Demat account is compulsory to hold your shares. That we'll discuss in the next chapter. So after 1 year, I feel to sell the shares. I feel to encash the shares. The market price is increasing, so I want to sell the shares. So what I can do, I need not to go back to company. Rather, I cannot go back to company and offer, hey, I bought your shares 1 year ago, you take them back and give my money back. That I cannot say as far as share market is concerned. That you can do in mutual funds when they are open ended. I will tell you that when that chapter comes. So now I want to sell my shares. What I can do? I can go into stock market and sell my shares to some other investor who is willing to buy the shares, right? Suppose Mr. X is willing to buy Reliance shares at rupees 1000. I want to sell my Reliance shares at 1000. So I can directly sell the shares to Mr. X at the desired price. So here, Reliance company is absent. So without giving or taking anything from the company, if shares are traded between the investors, they are called secondary markets. So, can we say that secondary market is a stock market? Of course, in a vast majority cases, stock market and secondary market acts synonymously other than in OTC markets. We'll see what this OTC is now. So I repeat, primary market is a situation under which a company requiring capital directly issues its shares or other instruments to investors. On the other hand, secondary market is commonly referred to a situation wherein already issued shares are traded between the investors. Got it clear? Now, let us see the transaction nature of capital markets. Capital market transactions can be divided into OTC and ETC transactions. OTC means over the counter. ETC means exchange traded contract. So, what is this OTC and ETC transactions? OTC, over the counter, means both buyer and seller of the shares meet over the counter. They personally meet, they negotiate for the price, and they settle the transaction. This happens only in wholesale markets. That means when large number of shares are bought and sold, OTC transactions are preferred. Suppose one share broking company holds 100 crore worth of shares in company A and it want to sell them to someone else. So what they will do? Will they go to stock market and sell 100 crore worth of shares? No, because the bargaining power under such circumstances will be more when demand for such shares rises. So the potential buyer of these 100 crores will also be an institutional buyer. Naturally, he will also have some bargaining power. So they both meet over the counter. That means they personally meet at the table and settle the transaction. That is called OTC transaction, over the counter transaction. Next, we have ETC transactions, exchange traded contract. ETC stands for exchange traded contract. It is very common form of selling shares in secondary market as far as retailers like you and I are concerned. Suppose I have purchased shares in L&T company. I retained with me those shares for 6 months. I want to sell them now in secondary market. So I will log into my Demat account. I will keep the sale order, say 1000 rupees per share. Some buyer is there, Mr. X or Y, who is sitting somewhere in Guwahati. Nor he met me, neither I met him. So none of us know each other. So he will give buy order for L&T company shares, say for example, 1000 rupees each. So price and order are matching. Automatically, our transactions will be swapped with the help of clearing corporation and stock market. So how those transactions will be swapped, we will see in the next class. So for now, you understand that ETC is exchange traded contract, wherein buyer and seller will not personally meet. Rather, they will buy and sell shares through a common medium called stock exchange. They are the commonest form of secondary market transactions as far as retail trading is concerned. Clear? OTC market is over the counter market generally preferred by wholesale buyers and sellers of instruments. On the other hand, ETC market is a retail format wherein buyer and seller will not meet personally but transacts via stock exchange. Right? So this is the classification of capital markets and nature of transactions executed in capital markets. Clear so far? Right. Let us go further now. After understanding the classification of capital markets and the nature of transactions executed therein, now let us understand various institutions working in capital markets. One is SEBI. It stands for Securities Exchange Board of India. It is the supreme regulator of Indian capital markets. It doesn't trade anything nor it make any investments. Rather, it is a regulatory body. Like we have Reserve Bank of India for all the banks to regulate the transactions in the same fashion, SEBI shall act as the regulatory body. It will enjoy quasi judicial powers also. That means sometimes it can issue orders. Its orders can be treated as final verdicts in some specific cases. Of course, that controversy can be challenged again, but for understanding purpose, we can take it as granted that SEBI acts as quasi judicial body and supreme regulator of Indian capital markets. Clear? So, it is brought into existence through a special act of the parliament and declared to be the supreme regulator. So, it is established on 12th April 1992. So, before 1992, there were capital markets, there were stock exchanges, but there was no regulatory agency. Rather, regulation of stock exchanges and share transactions was carried through a special act called Securities Exchange Act, that is Securities Contract Exchange and Regulation Act 1956. So, of course, that act still is there, but SEBI is the regulatory agency, is an institution that is instituted in 1992 when government has speed up or government has conceived economic reforms as part of 8th 5-year plan. Second, we have important institutions in capital market, that is stock exchanges. Stock exchanges are the tangible entities which provide a platform for execution of secondary market transactions. There are 22 stock exchanges in India, right? Of those, four stock exchanges have got national importance. Let us see what are those four stock exchanges. But before we see those four stock exchanges, I must tell you something, that stock exchange is generally a replica of secondary market transactions. Clear? So SEBI is the regulatory body of Indian capital markets, and stock exchanges only provide a platform, a common platform through which secondary market transactions are executed. Now, let us see what are those four stock markets having nationwide importance. Here I gave 22 because I confine myself only to share segment. There are, of course, special markets like multi commodity exchanges that won't fall into the direct ambit of capital market instruments. Commodity market segment is altogether different, though they are integrated to financial markets. So, keeping these commodity markets aside, we have 22 stock exchanges nationwide, of which four stock exchanges have got nationwide importance and nationwide access. Let us see what are those. So these stock exchanges, four stock exchanges are Bombay Stock Exchange, namely BSC, National Stock Exchange, NSE, OTCEL, that is Over the Counter Exchange Limited, and ICSCL, that is Interconnected Stock Exchange Limited. The first one, of course, the oldest stock exchange in entire South Asia, that is Bombay Stock Exchange. It is the oldest stock exchange in South Asia, which was incarnated as Native Shares and Stockbrokers Association way back in 1850s and acquired formal license under the Securities Contract Regulation Act in the year 1956. See the beauty here. The old name of BSC was not BSC, rather it was Native Shares and Stockbrokers Association. It was established in 1850 by the trade textile millers of Mumbai and Ahmedabad, especially when there was a Cold War in US and US depended on Indian textile millers to meet their textile requirements. So textile millers wanted to pool the capital, so they came forward with a stock exchange called Native Shares and Stockbrokers Association. It carried business without any regulation, without any license, almost for 100 years. But only in 1956, when we had Securities Regulation Act, government granted formal license to this Native Shares and Stockbrokers Association and renamed it as Bombay Stock Exchange. Clear? So, this Bombay Stock Exchange became a public limited company in the year 2005. See the beauty, almost for 150 years, it has accommodated hundreds of public limited companies, but it was not a public company. It was an association. But only in 2005, BSC became a public limited company. Its main index is Sensex, that is sensitive index, with a base year 1978. Of course, so the base value is 100. How this base value is composed, how index is composed, how Sensex should be read, I will explain you in the next chapters. But for time being, you remember that BSC is the oldest stock exchange and it became public limited company only in the year 2005, its main index is S&P Sensex. Clear? So now let us see the next one, that is NSE. Well, National Stock Exchange is the first public sector stock exchange established under the hegemony of government institutions in the year 1995. Remember, BSE was not established by government agencies, rather, it was established by private traders. But NSE is the stock exchange brought into existence by government through its financial institutions like LIC, SBI, so on and so forth. It is the biggest stock exchange in India in terms of market capitalization. Market capitalization means number of shares traded of a particular company into the share price, that is called market capitalization. So how it is important in stock markets we will understand when we learn to calculate Sensex and Nifty. By the way, the index of Bombay Stock Exchange was Sensex and the index of NSE is Nifty. Of course, there are many indexes, but the major index in NSE is NSE S&P Nifty. It will have 50 shares in it. We will see how it should be composed. Next we have OTCEL, Over the Counter Exchange Limited. It is a customized stock exchange established in the year 1997 with the main objective of providing secondary market platform for OTC transactions. I told you already that large scale investors, when they buy and sell shares in hundreds of crores or 10%, 15% of a share of a particular company, they will not buy and sell online. Rather, they will have their own bargaining power, meet over the counter, and execute the transaction. So, in order to provide authenticity to such transactions, in order to provide a common rostrum to such transactions, a new stock exchange came into existence, that is OTCEL. This OTCEL is meant only for OTC transactions but not for retail ETC transactions like us. Next we have ICSEL, that is Interconnected Stock Exchange Limited. It is an integration of regional stock exchanges established in the year 1997. We have some like Bangalore Stock Exchange, Ahmedabad Stock Exchange. So they are confined to one specific region, right? So if the investors or other stakeholders of other region wanted to participate in it, integration was a major problem in those days. So to integrate all these regional stock exchanges to have a nationwide access, one virtual stock exchange is created, that is called ICSEL, Interconnected Stock Exchange Limited. Clear? So Bombay Stock Exchange, National Stock Exchange, OTCEL, and ICSEL are four major stock exchanges having nationwide access apart from 22 other regional stock exchanges. I repeat, I am not including commodity exchanges like multi commodity exchanges, though they have nationwide integration, because we are now discussing capital markets and not commodity markets. Clear? Let us see what are the other institutions. We have so far covered a regulator, that is called SEBI, and next we have also seen stock exchanges. So, what is the third important institution in capital market? Let us see. The next important institution playing the most indispensable role in capital market is banker to issue. Banker to issue, or simply issuing banker, maintains a conditional account to collect the share application money which shall be made available to issuing company once the shares are allotted to applicants. What is this? Suppose a company gives an advertisement in IPO that we are issuing shares to public. The desired parties can make application through money. So I sent my money to the company and company did turn the board back. So it has not come forward to issue shares. So who guarantees my money? There must be someone, right? So that is banker to issue. This banker shall maintain something called escrow account, a conditional account, so that my money will be deposited in that account and company will be allowed to use that money only once the confirmation is given to banker that shares are allotted to so and so shareholders. Who will give that confirmation? That confirmation has to be given by Clearing Corporation of India. So what the Clearing Corporation we will see in the next slides. Next we have share brokers. Share brokers buy and sell the shares on behalf of the investors. Their role has become nominal with the advent of demat system in India. See, demat system enables me to buy and sell shares online in digital format. But before 1997, shares were bought and sold in paper form. So when you had to sell the shares, you were forced to go to share broker who had access to stock market, who used to stand on the floor of stock market and sell the shares on behalf of us, just like a subsidy market we see. So that subsidy market mechanism is done away with the introduction of demat system now. So now the role of share brokers is very nominal, especially in retail marketing. Issue companies. These are the public limited companies issuing their shares to investors for the purpose of raising the capital, which are listed in any one of the stock exchanges in India. Right? So any company that issues shares to common public is called an issuing company. So after issuing shares, within 3 days of closing the IPO, the company name must be listed in at least one stock exchanges of India, at least in one registered stock exchange in India. It can have registration in more than one stock exchange, but at least in one stock exchange, it must be registered. Clear? So, apart from these bankers to issue share brokers and issuing companies, there are very other important institutions playing dominant role in capital markets like clearing corporations. Clearing corporation will act as a mediator between all the transactions between all the parties. For example, I am offering to sell the shares, right? So you want to buy my shares. What is the guarantee that I will collect money and give shares to you? I may collect money and go out, disappear. So to avoid these circumstances, this type of frauds, we have something called clearing corporation. What clearing corporation does? It will take shares from me, it will take money from you, and it will swap the transaction. Shares will come into your demat account and money will come into my savings account. So providing authenticity to transactions is the responsibility of clearing corporation. Similarly, we have depository participants. Who are the depository participants? They are licensed by SEBI to operate demat accounts. If I want to buy or sell shares, I must have a primary account called demat account, dematerialized account, right, in which my shares are deposited whenever I bought the or buy the shares. So these demat accounts are provided by depository participants. They are licensed. We have so many depository participants in India, like India Infoline, India Bulls, Zeojet Securities, so on and so forth. Right? Just a saving bank account in bank, we have demat account with depository participants. So apart from depository participants, we will also have someone called underwriters. Who are these underwriters? Underwriters will ensure to the issuing company that minimum subscription will be made. We have a rule that whenever a company issues shares to public, minimum 90% must be subscribed. Otherwise, company cannot allot shares, right? So in order to ensure that minimum 90% shares are sold to public, we will have one intermediary called underwriter. He will either sell the shares in market, or if any under subscription is there, he will buy the shares of the issuing company. So for that purpose, he will charge some consideration called underwriting commission. Clear? So these are the very, very important institutions we have other than investors. Clear? So we have seen supreme regulator, that is SEBI. We have seen stock exchanges. We have seen clearing corporation. We understood what is depository system or depository participant, who are share brokers, who are bankers to issue, and who are issuing companies. Now, an important institution or important organ of capital market who converts their hard-earned savings into investments. Who are they? They are the investors. So let us see who are the investors we have in India. So, friends, investors are the individuals and entities subscribing to the capital issued by companies. Investors are ramified into following categories, namely qualified institutional buyers and non institutional investors. QIB stands for qualified institutional buyers. There are of two types again. One is foreign institutional investors or foreign portfolio investors. They are the foreign investors who just make investments in Indian financial markets. Please remember, FDI is different from FII. FII will make investments only in stock market, whereas FDIs will come here, invest in factories, assets, do actual business, but not the financial market business. On the other hand, we have domestic financial institutions like mutual fund companies or security companies or insurance companies, banks, whoever trades in stock markets with their subsidiary units. Of course, bank cannot directly trade in stock market, but through its subsidiary institutions it can trade in stock market. So they are called qualified institutional buyers. On the other hand, we have non-institutional investors like individuals, wholesale investors, and retail investors. So, any one person who buys more than 5 lakhs rupees worth of shares in a single company, he is called a wholesale investor. If you buy shares less than 5 lakhs rupees in a company, you are a retail investor. Clear? So, these are the important institutions or intermediaries participating in capital markets. We understood what is capital market. We have seen the classification of capital markets. We have also seen the important institutions or intermediaries playing an indispensable role in Indian capital markets. We'll stop here. In our next class, we will understand what are the capital market instruments. So, intentionally, I am terminating the topic here because it's a very lengthy one. It requires at least 30 minutes or 40 minutes for me to cover the instruments of capital markets. Therefore, we'll make it short here. We'll stop. See you in the next class with capital market instruments. Right? So, see you with next topic. Have a nice day. Be safe.